Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with PHTV4 and Palos Heights. My co-host is Paul Munico from Ameriprise Financial. Today is November 7th, 2022. Paul, can you give us an update what took place last week?
Yep, I'm still going to focus on earnings and forecasts because that is what is in the news right now that we have data on. So today we're going to hit on forward estimates and how they're still falling. Through last Friday, 85% of S&P 500 constituents had reported their financial results for the third quarter. Another 30 S&P 500 companies are scheduled to release their Q3 results this week, which will take the completion percentage to 91% by the end of the week. Now, thus far, Q3 earnings per share look to be genuinely in line with forecasts on better than expected sales. Now, earnings per share are currently seen as rising by 2.2% year over year, which was 2.1% last week, on sales growth of 10.5%, 9.4% last week. All data according to FactSet. Now, at the end of the quarter, which is September 30th, consensus estimates were looking for Q3 EPS growth of 3% on sales growth of 8.5%. So as we've noted previously, the energy sector accounted for most of the earnings upside in Q3. Excluding the energy sector, S&P 500 EPS growth would be down 5.2% year over year on sales growth of 7%. Now, forward estimates, meanwhile, continue to fall. As of Friday, consensus estimates for Q4 look for EPS of $55.18. That's down from $55.97 last week. And this is down sharply from the $58.13 expected for the period at the end of September. And believe it or not, the $60.81 forecast at mid-year. Now, likewise, EPS estimates for 2023 now look for full-year earnings of $233.49, which is down from the $241.67 at the end of September and $250.94 at the end of June. So as you can see, these estimates just continue to fall. If you're looking for more news or outlook for the S&P 500 earning estimates, feel free to reach out to me. I've got more data on this, and I'm happy to pass it along if it's something that the viewer at home is interested in.
And this morning's news that we received from Ameriprise Financial, the U.S. stock index futures are higher this morning after the S&P 500 posted a loss of 3.3% last week.
Yeah, that was disappointing last week after the prior week being pretty positive. When you give your year-to-date returns at the end of your portion, we need all the growth we can get to make those numbers back. So we'll take today's, at least futures updates, and hopefully they hold.
Yes. The markets in Asia closed higher on rumors China is considering relaxing its strict zero COVID policies.
That would help the global economy.
That sure would. And Europe reversed and is now trading higher. Good sign.
So it looks like we're trading higher across the board, at least this morning. It's a good sign. You're right.
Treasury yields are mixed, with the 10-year modestly lower, 4.15%, and the 2-year marginally higher at 4.70%.
Yeah, nothing significant there.
No. Bitcoin futures are down 2%. Gold is up 0.3% after gaining 2% last week. WTI crude is down 0.6% after gaining 5.5% last week. Now, the index returns year-to-date. S&P 500 a minus 19%. Dow Jones a minus 9%. A NASDAQ is a minus 33%. Some improvements So,
Yeah, I mean, we're down
very
to our
low.
last 2 months of the year, and we'd like to post better numbers than that for 2022. So hopefully the markets respond positively, maybe after the elections. Who knows what the market is looking for, but hopefully those numbers get better before the end of the year.
Before the end of the year. Thank you, Paul, for stay with us. We are going to be bringing you our show called Your Money. Paul usually has a very interesting topic. Stay with us. We'll be right back. Thank you for staying with us. Our show called Your Money. Paul has an interesting topic. We touched on this earlier in the year. Required minimum distributions. We're getting to the point, we're running out of time. Those are things that have to be taken. If you don't, you're going to have some issues with the IRS. Paul, I'll let you take it.
Thanks, Ron. You know, by the time you retire, IRAs and other retirement accounts may represent some of your largest assets. If this is the case, and even if it's not the case, you've likely enjoyed the benefit of tax-deferred growth of earnings on those accounts for many years. But at some point, Uncle Sam will want you to start taking distributions from those assets and, of course, pay the appropriate taxes due on them. This explains the existence of required minimum distributions, more commonly known as RMDs. Now, at a certain stage in life, the tax code requires that you begin withdrawing at least a minimum amount from your IRA on an annual basis. This is true regardless of whether you need to take the money out of these accounts to meet your cash flow needs in retirement. So I'm going to go over some answers to some of the most important questions that I usually get about RMDs and how they apply to your circumstances. Common question I get is, at what age do RMDs first apply? Answer is, the year you turn 72 is considered your beginning date. You do have until April 1st of the year after you reach age 72 to take your first required distribution, but check with your tax advisor on recommendations and confirmations on your RMD, so we're sure you don't miss it. Question number 2, after that first year, what is my deadline to take a required minimum distribution? Answer, in every subsequent year, RMDs must be received by December 31st. Special note that if you wait to take the initial RMD until the year after the year in which you turn 72, you will have to take 2 distributions in that same year, exposing you to potentially greater tax liability. Again, confirm with your tax advisor before taking and that you're taking the proper RMD. Next question, what accounts are subject to RMDs? The answer, traditional IRAs, SEP IRAs, and simple IRAs. Also, RMDs apply to workplace plans such as 401ks, 403bs, 457s, profit-sharing plans, and other defined contribution plans, to name a few. RMDs can be delayed from workplace retirement plans until April 1st of the calendar year in which you retire if you remain employed with the plan sponsor past age 72. Caveat to that, just confirm that information with your plan provider just to confirm that that applies to your workplace plan. Next question, are Roth IRAs accounts subject to RMDs? Answer, one of the great advantages of Roth IRAs is that RMDs do not apply, so your money can continue to grow on a potentially tax-free basis indefinitely. However, RMDs do apply to Roth 401ks. Next question, how are RMDs calculated? Answer, to make the calculation, you must first know the value of the account at the end of the previous calendar year. Then, Using the tables provided by the IRS, the minimum distribution is calculated. So for most 72-year-olds with, say, a $200,000 balance on December 31st of the previous year, that amount would be divided by a factor of 27.4 years, in that example resulting in a required minimum distribution of $7,299 for the first year. The distribution period declines throughout your life, and in certain situations, a different IRS table is used to make the calculation. Next question. Do distributions have to come out of all effected retirement accounts? Answer: yes. Once you reach age 72, RMDs must be withdrawn from each account subject to the rule. Therefore, it may simplify the process to consolidate your retirement accounts. This includes rolling workplace retirement plans in their IRAs. You can potentially take some from other accounts and less from others, but again, we need you to talk to your financial advisor and tax professional to discuss the pros and cons of consolidation and which and what IRA accounts or 401ks to make your withdrawals from. Next question, this one I get frequently. What is the penalty if I fail to take RMDs on a timely basis? Answer: if you fail to take an RMD in a given year or withdraw an insufficient amount, a penalty equal to 50% of the value of the amount you failed to withdraw as required will be applied. Next question, what if I don't have a need for the money I'm required to withdraw? Answer: just one option is to utilize a qualified charitable distribution, a QCD. Now this allows money to be distributed directly to a charity. Such a distribution can be applied towards your RMD in a given year. There is a $100,000 annual cap on the QCD. And just in conclusion, as I always state, please speak. We're talking in just general terms on this show. You need to speak with your tax advisor and your financial advisor to get the specifics on your situation. And the information today is just designed to help you understand some of the basic rules about RMDs. However, again, it's important you meet with your financial advisor and tax advisor to talk about RMDs in the context of your overall investment strategy, income strategy, and what your tax advisor suggests to make sure you are complying with the tax rules.
Wow. You better talk to a professional. Try to do all that on your own. Paul, if they have a question.
Absolutely. Feel free to give me a call directly at 708-226-3412.
Thank you, Paul, and Ameriprise Financial. For Paul Munichel, myself, Ron Jankowski, we wish you good investment day.